Joining me now in the studio is Harvey Flax, Director of U.S. Interest Rates Futures Business Development for Intercontinental Exchange. Harvey, welcome.
Good morning, Kristen. Thank you for having me on.
Always good to have you here in studio to set up these big Fed decisions. We get just about probably 10 a year, right? Roughly?
There are 8 meetings a year, yes.
8 meetings a year. Thank you for that. So what are the futures markets indicating about this upcoming Fed meeting?
So the futures market is priced in a near 100% probability today that the Fed will maintain interest rates on hold, that the monetary policy rate, Fed funds, will stay at the 4.25% and 4 to 4.5% target range.
All right. So what are markets indicating about the expected pace and depth of the cuts for the rest of the year?
So the Fed has certainly communicated that inflation is headed in the right direction towards a 2% target, and that I guess the labor market is steady state. They have also indicated that they're in no rush to lower interest rates at this time. They need additional time to assess any data related to the administration's ever-changing economic policies, and they have the luxury of time. Now, with that on background, the futures market assesses daily data, and they are currently pricing in a 70% probability that the Fed will lower interest rates by 25 basis points at the September meeting. That goes to a full 100% probability with the October meeting. And then they are pricing an additional 80% probability of another 25 basis point rate cut with the December meeting.
Okay, so can you touch on the expectations for the Fed's release of the June Summary of Economic Projections? This is that so-called dot plot, and any comments that we might hear from the Fed chair?
Sure. I'll start with the dot plot, the summary itself. Consensus from the economists believe that the monetary policy, the marquee dot plot, will reflect a median forecast of a single 25 basis point rate cut for the rest of this year, for 2025. Those assessments are driven from statements from the 19 policymakers that have been made since the last Fed meeting in May. Breaking down the numbers a little bit, roughly 25% of those policymakers indicated rather hawkishly that they are concerned about an upward swing in inflation, and they'd be inclined to leave rates where they are this year.
Yeah.
Another 25% was basically reflective that they believe monetary policy is monetarily restrictive. They are more concerned about the labor market or impacts to the labor market, and that group would probably be responsible for 225 basis point rate cuts that would appear in the dot plot. And the rest fall in the middle. And they've been mildly hawkish. Their statements indicate that they would be open to cutting rates this year, but they need additional data. They need another couple of months to see any impact of their mandate from the monetary policy, the economic policies of the administration. They will be the driver behind the median forecast of a single rate cut for this year. Now, looking forward in time to next year, the economists believe that Fed funds will be around 3.25% to 3.5% by the end of 26. Now, you mentioned the rest of the reporting in the SEP. So there are basically 3 other reports: inflation, unemployment, and GDP. Economists believe that inflation, as compared to where it was in the March release, inflation will tick up to about 3.5% to end the year. Unemployment to about 4.7% by the end of the year, and unfortunately GDP will go in the other direction, drop to about 1.3%. Now, statements from Chair Powell, there's always wild cards, but essentially they believe he'll remain on message, steady state, that the Fed is focused on their dual mandate, lowering inflation, keeping the labor market steady, that any decisions around monetary policy will be based purely on data that they can incorporate into their models.
What are the implications for all this with mortgage rates and where they might be headed the rest of the year?
Sure. So mortgage rates, the bellwether 30-year fixed mortgage rate is driven by monetary policy, the Fed funds rate, as well as the 10-year sector of the U.S. Treasury yield curve. Now, the ICE rate lock 30-year fixed mortgage index has indicated that for the first 6 months of this year, that rate, the mortgage loan rate has been in a very tight band of between 6.75% and 7%. And that has been driven by the 4.25% to 4.5% stagnant Fed funds rate. And the 10-year note the yield on the 10-year note around 4.5% has been trading on either side of 25 basis points of that rate. Now, looking forward in time, the ICE rate lock mortgage future, the December futures contract indicates that 30-year fixed loan rates would be about 6.5%. about 25 basis points lower than where they are today.
Mhm.
And that's in line with a 25 basis point movement down in the federal funds rate.
All right, Harvey Flax joining us in studio. He's a director of U.S. interest rates futures business development for the stock exchange's parent company, ICE. Harvey, always a pleasure. Thank you.
Thanks, Kristen. Great being here.
Great to have you.